What's happening in Japan right now is becoming increasingly interesting because this is no longer simply a US rate story driving dollar-yen higher. The shape and speed of the move in Japanese government bonds is beginning to send a much broader signal about inflation, fiscal sustainability, and Japan's vulnerability to prolonged disruptions in global energy markets. If we start with this first chart, the blue curve shows where JGB yields were trading the day before the Iran war began in late February. The green curve shows Friday's closing level, while the yellow curve reflects where yields are trading now. The key takeaway is the aggressive bear steepening that's developed over recent weeks. Yes, yields are moving higher across the curve, but the acceleration further out the curve is what matters on this occasion. That's important because if this was simply a clean repricing of BOJ rate hike expectations, you'd normally expect a flatter curve structure as short-end yields rise relative to those at the long end. Instead, investors are increasingly demanding additional compensation to own longer-dated Japanese debt. If we look at the second graphic that shows BOJ pricing based on overnight index swaps, markets already had a pretty hawkish BOJ profile embedded before the latest acceleration in long-end yields took place. June is nearly 80% priced for the next hike, while almost 2 full hikes are priced by the end of this year. So the recent move in 20, 30, and even 40-year JGBs cannot simply be explained away as markets suddenly waking up to the possibility of the BOJ hiking rates. It was already in there. And that brings us to this next chart showing the individual moves by tenor. The sell-off further out the curve has become increasingly disorderly over recent days. Now, some caution is needed because liquidity conditions in super long JGBs can become very thin, exaggerating the size of moves, especially when volatility increases like we're seeing now. But even allowing for that, there's still a broader signal emerging around inflation risks, fiscal concerns, and Japan's external vulnerability if energy market disruptions persist. Japan remains heavily dependent on imported energy, meaning prolonged strength in oil and gas prices risks worsening both inflationary pressures and the current account simultaneously. In practical terms, more yen may be needed to be sold to pay for imported energy at the same time that Japan's inflation outlook continues to deteriorate. And I think this is where the story becomes especially interesting because markets increasingly appear unwilling to allow both the yen and the long end of the JGB curve to remain simultaneously protected. If we jump to the dollar-yen chart, suspected intervention activity from Japanese authorities earlier this month temporarily disrupted the uptrend. But the broader macro regime quickly reasserted itself, with the pair now pushing back towards 159. More importantly, while FX volatility was temporarily suppressed, stress almost immediately accelerated further out the JGB curve. So rather than removing the pressure, intervention may simply have shifted where the adjustment was taking place. That creates a difficult balancing act for Japanese policymakers. If authorities tolerate rising long-end yields, concern around debt sustainability may intensify. But if the BOJ leans harder against bond market volatility through heavier bond purchases or unscheduled operations, the pressure release valve may shift straight back onto the yen, especially with the broader macro backdrop that still favors yen weakness.